I'm Charlotte McLeod with investingnews.com, and here today with me is Brien Lundin, editor of Gold Newsletter and host of the New Orleans Investment Conference, which is where we are right now. Thank you so much.
Yes, we are. You're welcome. Glad to have you. I guess I'm supposed to talk into this and make it a little more. But yeah, glad to have you. It's a great crowd. Very enthused about the crowd that showed up. You know, it's been a tough market, as we all know. But we had people who really, a large contingent coming in at the last minute, just the last few weeks. And I think what's going on in the world, not just on the geopolitical end, but there's a lot of other things kind of afoot right now that people are hungry for some analysis and trying to figure out what's going on, because it affects not just the metals, but really everything. So yeah, it's really very gratifying to see so many people show up. We have a great lineup of speakers, as I know you've seen, and they're giving some great advice to very interested investors.
Yeah, okay. I think that gives us a good idea of sentiment, and interesting to see that influx of last minute people. I'm glad that they ended up coming. I know it's early in the conference right now. We're on the morning of the second day, but I have to ask you, just in case, have you had any highlights so far, any aha moments among the discussions? Because I know there's already been some good ones.
Yeah, there have been some good ones. There have been some good moments in what I can see. A lot of what I get from the conference is actually post-conference looking at the recordings, because I'm so busy going back and forth. But it was interesting to me to see a couple of our speakers, Jim Stack, who is I think the most accurate market analyst out there, who is positive on gold. Very impressed with how gold has traded, despite the fact that we've had strength in the U.S. dollar, strength in Treasury yields, and yet gold has performed very well. That's kind of a thing that I covered in my presentation last night as well. And Bob Prechter, who is the most famous Elliott Wave analyst out there, was also positive on gold right now. And more generally speaking, thinking we're entering kind of a major shift away from financial assets towards assets based on things, more tangibles in metals and commodities. So interesting points there, but as you say, it's very early in the event, and we have some incredible speakers coming up over the next really 2.5 days at this point, and really looking forward to what they're going to say as well.
Yeah, okay, good to get some early highlights anyway. And I have to tell you, I love to come here and talk to people, but it's really hard to sit here and miss the presentations. So, always a toss-up.
You'll have the recordings as well.
Okay, thank you very much. All right, so moving on to talking about some of our usual topics, we've got to bring up the Fed, because we just recently had the latest meeting. Rates were left unchanged, which I think was widely expected. But I wanted to ask you if there was anything that stood out to you in the statement or in Powell's commentary.
Yeah, not much different. They recognized the fact that the market is doing some of their work for them, the so-called bond vigilantes, by tightening policy, tightening or raising rates a bit higher than they intended, but not as much as I would have thought he would emphasize. The policy statement had one word difference from the previous statement, and I even forget what that word is at the time. So not a lot, nothing unexpected. It was the most widely watched non-event that you can imagine, and expected to be a non-event going into it. The market reaction was more, I think, a relief that nothing surprising happened than anything else. So it was, I think, the most anticlimactic Fed meeting that we've had in a few years.
Interesting. And next one coming up in December. We're always looking forward to the next one. Do you think more of the same then? Have we reached the top of the hiking cycle, as some people think?
Yeah, my thesis has been that this hiking cycle is essentially ended. We might have another quarter point hike at some point, but I think that would be trying to deliver some kind of a rhetorical message and then an actual effect to the market. The QT is ongoing, which means that the Fed has removed itself as a buyer of U.S. Treasuries. I think that's the big thing going on right now, is that there's an enormous amount of Treasury securities paper that has to be loaded onto the market over the next quarter or so. And there's a lack of buyers right now, and especially a lack of buyers at current yields. So the market is demanding from the Treasury higher yields if they're going to take on that risk, because we're in a period right now where I think it's a big policy shift is very likely at some point. And investors are trying to bet on the timing of that. That's kind of the only reason anybody is buying the 10-year Treasury right now. It's not for the yield. It's betting on when the Fed pivots. And it's a speculation on capital appreciation and not yield-based. And so that's what's doing some of the Fed's tightening for them right now. So yeah, I think there's a turning point coming at some point. It's just trying to figure out whether it's next week, next month, or next year. And that's always the hard part.
Yeah, and I wonder if you could say more about what's going on with Treasuries right now. This is one topic that we didn't bring up in our previous conversation, which was quite recent. And I know you talked a little bit about it now, but I find it very complex. And I wonder, if you had to break down for investors just in an easy way to understand what's going on.
Yeah, we didn't talk about it last time probably because there wasn't that much going on, and what's really interesting to me, if you look at what happened when Hamas invaded Israel, and at that seminal event, you had a spike in the gold price, which is to be expected. It's a flight to safety, safe haven investment. And at that time, we had Treasury yield, say the 10-year yield, fell, which you would expect too, because the Treasuries are a safe haven investment as well. So people flocked into Treasuries, and the yield dropped. But it dropped for only a few days. And then the bond vigilantes, as they were, came in demanding higher return for the risk, and Treasury yields rose. And that was a break of a long-standing inverse relationship between Treasury yields and gold. Gold kept going up. And what's really interesting about not just the last few weeks, but really over the last few months is the dollar's going up, gold's maintained. Treasury yields have risen, gold's risen. It's really it's like cats and dogs living together. It's like all of the old relationships are breaking right now, which kind of signals a turning point in the markets. The one common characteristic is that gold is finding excuses to rise, even when Treasury yields go up, even when they go down, even when the dollar index goes up, even when it goes down. So the correlations are different, they're breaking, and that's generally the sign of something shifting in the markets. And nobody can really predict what's going to happen in any great detail, so don't even bother asking me. Nobody knows. But one thing we can be pretty confident of is if we do have this kind of a shift in the markets, this kind of added volatility, you're going to want to own gold going into it.
Yeah, and I love how you put it in that, gold is looking for excuses to go higher. So I did have a question on gold because when we talked a month ago, it was much lower than it is today. I think it was about 1870. Right now we're 1980-ish. And I was going to ask you, what has caused that? Because we had talked about that higher for longer strategy is keeping the lid on gold. But I think you've summed up kind of why that might be happening.
Yeah, if you look at the price chart, it is an absolute V formation. Gold was in the midst of a dive when probably the last we talked or before we had the situation in the Middle East erupt, and then that shot it right back upward. It was falling because of the Fed rhetoric and their seeming determination to go higher for longer. What's changed since then is, of course, the geopolitical angle. But there's something going on under the surface in that the market and investors are starting to realize the veritable flood of new Treasury paper that's going to have to be issued over the coming months, some $10 trillion or more. And realizing that this means not only that rates are going to have to rise because there's not that many buyers in the market. The Fed itself has removed itself from the market. Other central banks aren't buying Treasuries as they used to. So the market will demand, the bond vigilantes, as it were, will demand higher yields. And gold is responding to that kind of instability, the fact that there's going to be so much more paper issued, so many more dollars created, that will dilute the value of those securities and of the currency itself. So gold in this instance is actually recognizing not just the geopolitical crisis and concerns, but also the underlying concerns of massive deficit spending, massive increases in debt, and how that's all going to get financed.
Yeah, I was going to ask you if you could kind of explicitly connect that back to debt, because I know it's a favorite, well, maybe not a favorite topic, but it's one that we go over a lot of the time, and it's important to you.
Yeah, we are going to continue to reset the interest rates of the federal debt. And in particular, as I mentioned, we have about a $2 trillion deficit this year. We have a backlog of paper that still has to be issued from the debt ceiling crisis of a few months back. And we have, I believe it's about $8 trillion or so dollars in Treasury debt that's rolling over and has to be refinanced at current rates over the next quarter or so. So it's just a massive tsunami of new paper issuance coming up. And all of that debt will be reset at near current rates. So as we are adjusting from very low interest rates to much higher interest rates on the federal debt, the cost of servicing that debt is soaring. Right now, when the latest numbers were at $981 billion, so really right at that magic $1 trillion mark. It'll get quickly to $1.5 trillion in interest expense as that debt gets reset. That's a tremendous amount of money that goes toward nothing, doesn't go toward infrastructure, doesn't go toward entitlements. It goes into the pockets of investors who bought that Treasury debt. It's a political problem, in other words, and not just a fiscal problem, but it's a problem in both sectors. And I think, that's something that, as you know, I've been talking about for an awful long time, probably the last 3 or 4 years. And now I think it's coming to a head. I think we're seeing that. And we're seeing that reflected by gold's reaction.
Okay, thanks for going into that. And I won't ask you directly what's going to happen to the gold price. I'm going to move on. Yes, I'll move on to uranium. So in that previous interview that we did about a month ago in the lead up to this conference, you mentioned uranium as a sector that you're looking at. We just talked about it briefly, but I saw that people online had kind of picked up on that. So I thought it's worth going back to. And we've had prices rising pretty steadily for the last several months for uranium, or we can look back to a rise over the last years. So what is telling you that this is the time that it's real?
We're finally getting to the point where the utilities have to resupply. Contracts are running out, but importantly, it's the uranium story has been one of almost ceaselessly rising demand. And when you can look at the long-term trends and see that demand is going to be rising for years and years to come. But right now, it's a supply issue. Russia has been effectively removed from the market, not just as a supplier, but as a processor. And that's where the real pinch point in the supply chain is coming. And the utilities have just started to, I don't want to say they're in panic mode because they're not, but they're much more eager to go into the market and lock up supplies, which is driving up the price. And of course, we have the Sprott Physical Uranium Trust, which is an aggressive buyer, attracted a lot of investor interest, and it's taking a lot of that uranium off of the market when the utilities are just starting to go back to the market.
Yeah, I feel like in uranium, you could talk almost endlessly about the different supply-demand factors that are contributing to what's going on right now. The other thing I wanted to ask you about, so the universe of uranium stocks, we know that it's quite small, and I'm wondering how you like to approach it, because I hear a lot of people say, or you can just stick with the big ones. You can go for Cameco, you could go for Kazatomprom promise you're okay with that kind of geographical risk. But, there's options on the smaller end of the scale too. So what are your thoughts?
Yeah, there are. And, if we look at the broader universe of junior mining stocks, there's a few thousand out there. And I tell people it's a very inefficient market. You can do your homework, you can outwork other people, and you can use those inefficiencies to your advantage by finding great companies that have been overlooked in the market. When we had the great uranium mania back in 2007 and thereabouts, we had about 400 or 500 uranium companies that just sprouted out to take advantage of that euphoria. And they're all gone now. And there's maybe a dozen or 20 companies left that are worthy of looking at that are the survivors, the survival of the fittest. So they have taken those assets that were worthy out of those 400 or 500 companies, distilled them down to a dozen or 20 companies now that hold those assets that are much stronger, have much better assets. Now, what's going to happen is within that much, so it's an easier job to do your analysis. And when you look at those companies, the ones that are either in small scale production, which aren't many, or about to or close to production and can maybe take mothballed projects and get into production much more quickly, they're going to react first. And then as the euphoria kind of kicks in, you'll get into the exploration plays who have more of the grassroots types of plays. The place to be right now is those companies that are on the verge of production or being acquired by these companies that suddenly get stronger because they get appreciation in their market value.
Okay, and because you mentioned that mania phase, everyone looks back to that and they're excited to perhaps see that happen again this time. But I'm already worrying about exit strategies for people. So how can people handle that? Because we don't necessarily know that will happen, but
Yeah. It's a good problem to have, the exit strategy. And that comes when you have a long sustained bull market and you have a lot of, at least on paper, gains in these stocks. The key is not to fall in love with the story. And this is coming from somebody who habitually falls in love with stories, so I know whereof I speak. It's a tough thing because the whole idea of junior mining and investing is one of following these dreams in discovery, and it's a treasure hunt kind of a thing. So you get involved in the stories, and you have, and it's very hard to sell them sometimes. You need to force yourself to take profits, and you need to force yourself. You don't have to completely exit a position, but maybe do it in thirds as you've had some gains, and still keep a toe in the water. But you do need to focus that when the market hands you paper gains, you need to at some point turn them into real life gains.
I think that makes a lot. So you can go in your tranches, you can go out in them as well. It's not an all or nothing thing.
Absolutely. Absolutely.
Okay, so we're getting to the end. I'm going to finish up with what I think it's a fun question. Maybe we'll see. But looking for do's and don'ts for investors as we finish up the year and perhaps head into 2024.
Oh, yeah, we could go on for a long time on that. Yeah, we really could. The do, I think, is easy to me, that I think this is a generational opportunity in junior mining stocks. If you look back, and I may have said this in our last discussion, if you look back to, say, 2000, the last time the market bottomed, gold was about $252 an ounce. The mining stock market was as bombed out as it is today. But gold was at an all-time low. And it took a couple of years of a steady uptrend in the gold price before the junior mining stock market really started to light up. Today, we're only a few percentage points at this point from an all-time high in the gold price. So we don't need 2 years of a price uptrend to get the juniors going. We probably need 2 weeks or something like that to really get the market going. So the do, I would say, is if you're not already invested in the sector, get a position, not individualized investment advice, but generally speaking, be in this sector, because when it turns, it's going to turn quickly and hard. The don't is don't give up. Don't give up on it. We're in that part of the year where you can take some tax losses, et cetera. You need to do your individual portfolio management. But when it turns, and I think it is imminent, and I do think it's a generational opportunity, when it turns, it's going to turn very rapidly. So do be involved. Don't be completely out of the sector.
Perfect. So I think that's a great place to wrap it up, unless you had any final words you want to leave people with.
No, I think come to New Orleans 2024. This is a great conference this year.
Yeah.
And next year's conference will be our 50th anniversary event. So make your plans now for coming back here and next November.
Perfect. I've already marked down the date. So thank you very much for having us this year. We'll see you next year. And of course, we'll talk in between.
Right. Thank you, sir.
Of course, we'll let you go back out on the floor. Once again, I'm Charlotte McLeod with investingnews.com, and this is Brien Lundin of Gold Newsletter. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.